Hello and welcome back to another learning module. In this learning module, we'll be dealing with Chapter 15. Now, Chapter 15 talks about long-term liabilities. So we have actually 4 learning objectives for this chapter. So after you complete your studies of Chapter 15, you should be able to describe the major characteristics of bonds. You should be able to explain how to account for bond transactions. You should be able to explain how to account for long-term notes payable. And then finally, you should be able to report long-term liabilities as well as analyze long-term liabilities. Specifically in this video, we're going to discuss some of the major characteristics of bonds, what exactly are bonds, how are they issued, and things like that. So the first thing that we need to look at is what are bonds, right? And bonds are nothing more than long-term liabilities. Long-term liabilities are obligations that are expected to be paid after 1 year, okay? So when we're looking at long-term liabilities, what does that include? So I definitely put this in your notes. When we're talking about long-term liabilities, we're talking about things like bonds. We're talking about things like long-term notes payable and lease obligations. Keep in mind that the key to each of these liabilities is the fact that they are expected to be paid after 1 year. Okay, so when we think of bonds, bonds are really a form of interest-bearing notes payable. That's really all they are. Okay. Bonds, and if you're familiar with the bond market at all, or look at any, Yahoo Finance or Google Finance or anything like that, bonds actually sell in lots, right, or small denominations. And normally they're going to be in lots of 1,000 or multiples of $1,000. So that's the par value of a bond, $1,000. Now, why would a company offer a bond? Or in other words, what are the advantages of bonds over common stock? Because in Chapter 14, we looked at we went through common stock, preferred stock, how to book stock, and all that, right? So we're just looking at another form of a company's or a corporation's way of generating cash, right? Think about there's 3 ways. There's 3 ways that a company can generate cash, right? Number 1, it could generate cash hopefully through operations, right? It has efficient and effective operations, so they're generating income through their core business. They could sell stock, or they could issue bonds. So that's one way that a company kind of generates cash, right? We're not talking about revenue, talking about cash. So when we're looking at the bonds, the reason why, or some of the advantages that they have over that common stock is, number 1, stockholder control is not affected. So whenever we put out a bond or we issue a bond, our stockholders still maintain their control, right? If you think back to Chapter 14, we talked about, hey, if we issue new stock, we're going to dilute the current shareholders, right? We're going to dilute their power. We're going to dilute their earnings. With a bond, that is not the case. So the stockholder maintains their control. Their control is really not affected at all, okay? There are tax saving results from bonds. Why? Well, think about it. When a company prepares their income statement, they are allowed to deduct interest expense. A bond is an interest-bearing note, pretty much. So that stands the reason that if a company issues a bond, or a company would choose to issue a bond over more common stock, because they're getting a tax savings, okay? And then finally, the third advantage really has to do with the return on the common shareholders' equity, right? Those common stock might actually have a higher return in the presence of the company taking on some bond debt, okay? And those are the 3 main advantages of bonds over common stock. But if we're looking at the bond specifically and we're talking about its characteristics, right? We know it's it's in denominations of $1,000. Bonds attract many investors, right? Think about it. Why would somebody want to invest in a bond? Well, hopefully you're thinking, well, bonds are less risky than common stock. Okay, that might be one reason. Another reason might be that the investor is looking to generate income. The investor can generate income by investing in a bond. In return, they receive interest payments, right? So that's one characteristic, or that's another actually characteristic of a bond. They attract many investors. Remember, this is the form, or issuing bonds is a way of a corporation to borrow money. They're borrowing cash. That's exactly what they're doing. Okay. Again, those persons who want to buy the bonds, they're called the bondholders. And the bondholders do nothing more than invest in bonds. So those are the characteristics of bonds. And we did discuss, again, the 3 advantages of issuing bonds over common stock. So I would definitely make sure you have those in your notes. Okay. Oh, sorry. Okay, so the next thing we want to look at are the types of bonds, right? So as you can see on the slide, we have secured bonds, we have unsecured bonds, we have convertible bonds, callable bonds. There's also something called a term bond, a serial bond, a registered bond, and a non-registered bond, right? So we got all these types of bonds, okay? Let's look at the secured bonds first. What is a secured bond? Well, a secured bond actually has a specific asset of the issuer that is pledged as collateral for the bond. So that means that the bond is secured by an asset, okay? What happens here is the company says, I want to issue a bond. I'm going to choose to make it a secured bond. That means that I have an asset. It doesn't matter what the asset is. It could be an investment account or a portfolio of investments that the corporation has. It could be the asset itself, okay? So let's say, for example, I need to raise $1 million cash because I want to buy this brand new machine that's going to help me make widgets, right? I'm going to make widgets, sell them, and hopefully turn a profit, right? Because I have a secured bond, this $1 million asset that I'm going to buy by borrowing money from a third party, aka the bondholders, I pledge that piece of asset, or I pledge that asset as collateral. Meaning, if I am unable to make my interest payments, right, or if something happens that I can't pay back those bondholders, I could sell that machine, and the cash that I generate from selling that machine, I turn around and I give that cash to the bondholders, okay? Keep in mind, this is just a way for bondholders to have some security, right? How is the bondholder getting paid? Well, normally, through all intensive purposes, I lend a company money so they can invest in their infrastructure or invest in a project. That project is going to make money, right? The money that they make from, or the profit that they turn from making that, from doing that project, or making making that product or supplying that service, whatever, that cash they're going to use to pay me back, right? They're going to pay me interest, and then eventually down the road they're going to pay me back, right? Because the bond is secured. If that action of the company making something and then turning around and selling it to someone else, if they're not making money on that, right, and it's not a good investment, the bondholders are secured in the fact that that asset can be sold to generate cash to pay those bondholders back, okay? A mortgage bond, this is a very typical type of bond that's out there. A mortgage bond is secured by the real estate. So I'm going to go ahead and assume that none of you guys own homes, but when you get to that point, you're going to take out a mortgage. That mortgage is secured by the home or the property that you're buying. So if you can't make payments to the bank, guess what? the bank has claim on that house. They can take that house, turn around and sell it to somebody else, take the proceeds from that sale to satisfy the loan that you owe them. Okay, so you're out of house, you're out of a house, but at the same time, you don't owe the bank really money because presumably you don't owe them money. Why? Because they took the house and they sold the bond, or they sold the house, right? To pay for that loan. Okay, again, very high level looking at it. We're assuming that the property can be sold for the value of, the mortgage. That's neither here nor there. We're getting a little bit too deep. The point is, a mortgage bond is secured by real estate. A secured bond is secured by a specific asset that corporation pledges as collateral. Okay? Unsecured bonds. An unsecured bond does not have does not have a asset pledged as collateral. Okay, so an unsecured bond has no collateral, right? So why would somebody want to lend a company money that isn't secured by an asset, right? That security is kind of like the safety net, right? Well, if they can't pay me, I could take that asset, make them sell that asset and give me cash. Unsecured bond says there's no asset pledged for collateral. What then is the company, or what then are the people or the bondholders? Where's their trust, right? What are they trusting? Well, unsecured bonds are issued against just the general credit of the borrower, right? There's a company that wants to issue me a bond. They say it's unsecured. I say, okay, well, I need a safety net. I need a guarantee, right? We know nothing's guaranteed, but I need a safety net, right? Something that I'll get a little bit of money back if something happens and you can't pay me, right? What's the safety net here? Well, the company says, I got outstanding credit. I always pay my bills. Look at my history, right? Every time I've borrowed money, I've paid the interest payments and I've paid those people back. The company says, I foresee that history continuing. I'm going to pay you back. So it's based on the creditworthiness of the company, okay? Another name for these unsecured bonds, you're going to want to have this in your notes. Another name for the unsecured bonds we call debenture bonds. DEBENTURE bonds. Debenture bonds. Okay? It's not on the slide here, but it's in your textbook. And another type of bond that a company can issue are called term bonds. Okay? Term bonds are bonds that mature at a single specified future date. We call those term bonds, okay? However, there is a counterpart to term bonds, and we call those serial bonds. Not Captain Crunch cereal. Serial as in one after the other. SERIAL bonds. Serial bonds. Serial bonds mature in installments, right? So instead of the term bond says, I'm going to issue $1 million worth of bonds, they will come due 25 years from now. Okay, so what is it, 2020? So we'll say March 31st, 2045, these bonds will mature, right? That's a term bond. The serial bonds say that, you know what? Yes, these bonds have 25 years maturity, but starting in year 20, okay, so 2040, we're going to retire $200,000 worth of bonds every year until the 25-year maturity. At that way, they're all paid off, okay? So basically, the only difference is, do I pay it when you're thinking about the difference between term bonds and serial bonds? Does the company pay it off in one lump sum, or do they stagger back, or do they stagger their payments? If they stagger their payments, that's a serial bond. Okay. The other type of bonds that are out there that really don't exist anymore, and the reason why these don't exist per se is because everything now is electronic, right? So the two bonds that are kind of, they're out there if you can find them. Registered bonds and registered bonds and bearer or coupon bonds. Okay. The registered bonds are what we have now, right? They're very prominently out there. companies issue a lot of registered bonds. Basically, what this means is registered bonds are issued in the name of the owner. They have interest payments that are made by check to the bondholder of record. So what that means is we issue a bond, we know who we issued it to, we know who to send the checks to. If that bond gets sold, and that can happen, right? If we are investors, we can buy a bond and invest in a bond to get those interest payments. Maybe for some reason we don't want to hold the bond anymore. I don't know why. There's a number of reasons why, but that's a little bit too deep for right now. The investor can sell the bond. When that happens, the company that issues the bond or the investment bank that's kind of the secretary for the bond, keeping track of all the information, what they will be notified of who the new bond holder is. So that's what a registered bond is. It means that it's registered with the company. The company knows who has the bond. Now, bearer coupon bonds are not registered. Okay, so there's like a bond certificate that goes out, right? Again, with technology the way it is today, bearer bonds or coupon bonds, if you see one, it's kind of like a unicorn, right? The reason why is because these bonds these bearer bonds or coupon bonds, they're not registered, right? So how does the investor get paid, right? How do they get their interest payments? Well, it's because the bondholder actually has to send the coupon in to receive that interest payment. So when we're talking about a bearer or coupon bond, the company has no idea who owns their bond. They're just waiting to get in those interest or those coupons so they can turn around and send out the interest payment, okay? Then we have what we call convertible bonds and callable bonds, okay? What's the difference between these two? Well, when we're looking at convertible bonds, and I love the picture of the convertible bug. I think that's awesome. And it really kind of explains what a convertible bond does, right? A convertible bond allows bondholders to convert the bond into common stock at their option. So basically, it is a characteristic of a specific bond that says the owner of this bond, if they choose to, can turn this bond in and be issued common stock. Okay? That's all it is. Callable bonds, these permit the bondholder, scratch that. The callable bonds, what this means is not the bondholder, but the bond issuer. So the corporation can call and redeem that bond at a stated dollar amount, right? Usually this is prior to maturity. This is only at the option of the issuer. Okay, so what in the world does that mean? Well, got about 31 of you guys. I need 31 grand. I issue you guys a bond. I say, hey, who wants to give me $1,000? I'll pay you interest. And at the end of 25 years, I'll give you your $1,000 back. You guys are all about it. You say, hold on. You guys are smart. You're savvy. You paid attention. You say, Professor Bruce, is this a secured bond or an unsecured bond? I say, it's an unsecured bond. What does that mean? And hopefully you look back through your notes or you remembered and you said an unsecured bond is a bond that is issued against the general creditworthiness of the issuer, right? Or of the borrower. I'm the borrower. So if it's unsecured, you want to look at my history and say, well, what's your credit rating? Have you paid your bills in the past? Do you pay them on time? Do you pay them early? Do you pay them when you're supposed to, right? I say, nope, this is going to be a secured bond. What's that mean? Secured bond means that there is an asset that is pledged as collateral, okay? This bond has a callable feature. What that means is, let's say that I borrow 31 grand in total from the class, and I invested in a project that I'm working on to generate revenue, and this product that I'm making, I mean, it's selling like hotcakes, right? It's like the new iPhone, right? Everybody wants it. Well, instead of me having that bond due, right? Or me owing you, all you guys, $1,000 plus interest over 25 years, I could call that bond back. And what that says is, you give me the bonds, I am going to give you your money back. Okay, it's going to be at a stated amount. So you're not going to have an investment in my company for 25 years, right? I'm getting rid of the debt, meaning I'm giving you money back. I'm not paying you any more interest, okay? That is at the option of the issuer. We'll get in a lot more detail of why somebody would do this or why a company would do this, and it has to do with the interest rates. But we'll get to that whenever we talk about how to record bond entries, okay? So very important, the types of bonds that are out there, make sure you know these. We added some more bonds that aren't on here, things like the bearer or coupon bonds, the registered bonds, term bonds, serial bonds. Make sure you know what those are, okay? So what's the issuing process? If I am a corporation and I want to issue bonds, what needs to happen? Well, first, state laws need to grant corporation the power to issue bonds, okay? So that's key. In order for me to issue bonds, I need to go to my state law, or I need to register with the state government and say, I want to issue bonds. That's number one, okay? Number two, just like with dividends, remember we said, hey, the board of directors need to declare dividends. The same thing happens with bonds in the sense that the board of directors, as well as the stakeholders or the stockholders, have to approve the issuance of a bond. So let's say I'm a corporation. I want to issue bonds. First thing I got to do is go to the government, state government, say, hey, give me the power to issue the bonds. They say, okay, here you go. I now have this power, and I need to have a vote. I need to go to my board of directors. Maybe I put a proxy, put a vote out to all the stockholders and say, hey, I need $100 million in cash. I want to issue bonds. The state gave me permission to do this. I need your approval. They say, yep, go ahead and do it. Fantastic. Okay. Then what happens? Well, the board of directors then gets together and they stipulate the number of bonds that we're going to authorize, what the face value of those bonds are, and what the contractual interest rate is. Now, this is key. There's a difference between the contractual interest rate and the market interest rate. Okay, the market interest rate is it's set by the Federal Reserve, and they specify what the current market rate is on interest. Right, it's based on, if you guys remember economics, or if you had an economics course, it goes back to basically what the Fed does is they regulate the interbank loan rates. Right. In other words, the stated rate that banks can lend to each other, okay? And that kind of fuels the interest rate at the market, right? So think about it this way. If you were to go out and get a mortgage, right? You want to know what's the stated rate, what's the contractual interest rate that I have to pay them, right? I'm going to compare that to the market, right? So we're going to see that a little bit more whenever we discuss the process of recording these journal entries, okay? Now, once the board of directors makes stipulates all the numbers of bonds that we can authorize, the face value, and again, that face value usually always going to be $1,000, right? The contractual interest rate that can change, meaning the board of directors can pick any interest rate they want. We are going to pay 2%. We're going to pay 10% annually. We're going to pay 25% annually, right? They can contractually stipulate what the stated rate on that bond is, okay? The next thing we need to recognize is that the terms of the bonds, meaning the face amount, the contractual interest rate, the maturity date, all that stuff, that is a legal document, okay? We call it a bond indenture, right? And basically, those are nothing more than the terms of the bonds, okay? A lot of times, well, in the past, now since everything is electronic, bond certificates really don't go out anymore. Usually it's all registered bonds. So there's no real paper that it transfers. I'm going to buy a bond. Well, I'm not going to send you a certificate. I got you on record. You're okay, right? Again, face amount, always going to be about $1,000, okay? So when we're looking at I want to go back and kind of talk a little bit more about the state laws that grant corporate power to issue the bonds, right? So what happens, right? Well, within the corporation, there's that formal approval that we need, right? And again, who gives us that formal approval? Well, the board of directors and the stockholders, okay? That's usually required before we can actually issue bonds, okay? Excuse me. So very important that, again, that you understand the process of issuing bonds, right? So remember what the bond is, right? It's debt, right? It is a promise to pay. I as the borrower, I as the borrower, the company, promise to pay you, the bondholder or the investor, some sum of money at some specific point and date in the future. That's the maturity date, right? That's when, the jig's up, fellas. I got to pay somebody, okay? We set that maturity date, whether it's 25 years, 10 years, 5 years, 50 years, whatever, okay? So the maturity date's very important. Next thing we got to look at is those periodic interest payments, right? That's that contractual rate or that stated rate, okay? What is the contractual or stated rate on? It's on the maturity, it's on the face amount of the bond at maturity, right? Face amount of $1,000. That's typical, right? You always see 1,000. Now, if I'm going to pay 7% annually interest rate, it has to be on that par value, that $1,000. So that means I'm going to pay what? I always mess up the decimal points. So if I take that $1,000 and multiply by 0.07, that's $70. So that means that it's contractually stated, or it's the stated rate, that I have to pay you $70 a year for 25 years. If let's say that's the maturity date, okay? Interest payments, those are usually semi-annually, right? We're going to get an interest payment every 6 months or 2 times a year, okay? Why do we issue a bond? Well, we're going to issue it because we need a large amount of long-term, or we need to fund long-term capital, right? Meaning, I want to buy a really expensive machine that's going to last me, 30, 40, maybe even 50 years. Okay, how do I finance that? That's what we're talking about. How do I finance that? How do I pay for that machine? I'm going to issue a bond, okay? And I'll pay my bondholders the interest. Now, keep in mind that the investment company, right? Those are the ones that sells the bonds for the issuing company. So what that means is if I am issuing a bond, I don't issue it myself, or the corporation really doesn't issue itself. That's not their business, right? Their business is making widgets. They go to an investment company. That investment company then kind of facilitates the selling of the bonds, okay? Again, this is an example of a bond certificate. Again, it's like a unicorn. Probably won't see it because everything's electronic now. But there's still a lot from here that we can take that we need to know that apply to registered bonds, right? Who's the issuer? We need to know that. Who is the issuer? So on the bond certificate, you know who the issuer is, right? They have that specified maturity date. And we can see here that International Minerals and Chemical Corporation has a $5,000 bond, and it comes due May 1st, 2020. That is the maturity date. Notice the stated rate or the contractual interest rate. That's 5.75% annually, okay? And then the the face value of the bond or the par value. In this case, it's 5,000. That's okay. It can be 5,000. Just has to be in increments of 1,000, right? So we have the face amount, the issuer of the bond, the maturity date, and the contractual interest rate or the stated rate, okay? So how then do we determine the value of a bond, right? Meaning the market value. We need to borrow $1,000, right? How do we determine what that bond is worth? Well, we have to think back, and you might have had this before. If not, if this is a new concept, not a problem. We need to look at the present value, right? And if you think about present value, it goes back to, I don't know if you've ever heard, a dollar today is worth more than a dollar tomorrow, right? Why? Why does that make sense? It's a dollar. Why is a dollar worth more today than it would be tomorrow? The idea is that you can take that dollar and invest it and earn interest, right? So let's just say it's 6% interest, right, per day, just to make the example work. A dollar today, how much is it worth tomorrow? Well, a dollar today, again, presuming I invest it, I can get a return of 6% per day. Tomorrow I have $1.06, right? And so forth and so forth. So we're going to get into the present value and trying to determine the present value of, or rephrase that. We're going to try and figure out what the current market price is by implementing the present value, okay? So there's three things that affect the present value. One, the dollar amount that's going to be received, the amount of time, and the market rate of interest, okay? Now, keep in mind, the market rate of interest is totally different from the stated rate. You have to know that, okay? Put that on a note card, write it in your notes, whatever, memorize it. There's a difference between the stated rate or the contractual rate and the market interest rate, okay? Excuse me. The market interest rate. What is the market interest rate? It is the rate that investors demand for loaning funds, right? I'm going to loan you money. What's the market rate? Well, I demand 7%, right? What sets that market rate? Again, the Fed does, okay? So let's look at an example of the market value of a bond, okay? Let's assume that Acropolis Company on January 1st, 2017 issues $100,000 worth of bonds. Those bonds have a 9% stated rate or contractual rate. It's due in 5 years, so that means the maturity is within 5 years. Interest is going to be paid at the year end. Okay, so we're going to pay interest at the end of the 5 years, okay? So the purchaser of the bond is going to receive the following types of cash payments. So in this example, I am Acropolis. You guys are the bondholders. You give me the cash that I need. I'm going to pay you 9% interest, and at the end of 5 years, I'm going to pay you back your original investment, okay? So let's look at what happens, right? You guys are going to get two types of cash payments. First, you're going to get the principal amount at maturity, okay? So let's just say each of you collectively, or each of you rather, give me $100,000. At the end of 5 years, I'm giving you $100,000 back, okay? On top of that, I am also going to pay you interest, right? The interest it's always going to be a yearly rate, okay? Meaning each year I got to pay you 9%. That's $9,000 for year 1, year 2, year 3, year 4, and year 5. That is $9,000 worth of interest that you get, okay? The cash flow, it's going to be paid annually at the end of the year. So that means the end of year 1, I'm going to give you $9,000. The end of year 2, I'm going to give you $9,000. Notice how I calculated that interest payment. And this is key, right? And write down in your notes. How do I calculate interest payment? I take the face amount of the bond, and I multiply it by the interest rate. What interest rate do I use? The stated interest rate, or the contractual interest rate. Okay? Excuse me. So basically we see that we need to figure out how much is that bond worth today, right? So I'm going to get $9,000 every year for 5 years. That's an annuity, right? What's an annuity? It's a stream of cash payments. In this example, we have a stream of cash payments of $9,000 per year for 5 years. Okay. How much is that cash stream worth today? Well, again, we need to use there's tables that we can use. Or if you have a financial calculator, you can use your financial calculator. But basically what we need to do is we need to go to the present value of a dollar table, present value of an annuity of a dollar table, and we find out that today you'd be willing to accept $35,007 for $9,000 every year for 5 years, right? We're bringing it back to the value of today, okay? How do we do that? Well, remember, interest rate affects that and time, right? What's the interest rate? 9%. What's the time? 5 years, okay? Same thing with the present value, right? We want to bring it back to today's dollars. You could get $100,000 5 years from now. Okay, that's great. But how much is that worth today, right? Well, it's $64,993. I bring that one payment back, that one payment of $100,000, I bring it back 5 years at a 9% interest rate, okay? So in theory, if you were able to find another investment, okay, not the bond, something else, and that other thing is going to pay you 9% interest. Today, if you invest $64,993 at 9% per year for 5 years, at the end of those 5 years, you're going to have $100,000. Okay, that's really what this is saying. The bond terminology, right? Make sure you understand this, okay? We talked a lot about these definitions, right? Mortgage bonds, sinking fund bonds. These are both examples of secure bonds. That's true. Remember, a mortgage bond is secured by that real estate. Same thing with a sinking fund bond, right? The company sets money aside. It's restricted money. They can't use it. It's set aside for the sole purpose of paying bonds or paying this bond, okay? Unsecured bonds known as debenture bonds. Yep, that's true, right? We talked about that. I said put that in your notes. That's probably an important one. The stated rate is the rate investors demand for loaning funds. That's false. Why? Because the stated rate is the contractual rate on the bond that the borrower needs to pay, right? That's the stated rate. The rate that investors demand for loaning funds, that's the market rate, okay? So make sure you really study and know, meaning memorize, just be able to rote memorization, some of these, what are these? Vocab words, okay? When we come back in our next video, we're going to look at explaining how to account for bond transactions, meaning what transaction when we sell the bond or issue the bond, what transaction do we have to do when we redeem the bond or we buy it back, and what transaction do we need to record whenever bonds are converted to common stock. So tune back in for that one.